Hello and welcome to On Watch by MarketWatch. I'm Jeremy Owens. Last week, we outlined why this is such a crucial moment for the economy and pointed to the two most important metrics to watch, the jobs report and corporate earnings. So today, we're going to dive deeper into both. First, we take a look at the June jobs report, which confirmed that the labor market is getting weaker. Economics editor Greg Robb explains why that's a reason to worry. Then we welcome tech columnist Therese Paletti to discuss the AI bubble and if Wall Street is ready to pop it. Plus, we'll take a quick look at the news stories we're watching right now and how they'll affect your wallet. First, let's talk about the labor market. For the last couple years, inflation has been the most important economic indicator for the Federal Reserve. There's good reason for that. Spiking inflation has caused a lot of economic pain for Americans, and it's still not under control. But even with inflation staying higher than their desired level, the Fed's leaders are now paying more attention to the labor market. Job growth has slowed down, and a sharper downturn could force the Fed's hand. Economics editor Greg Robb joined us after the latest jobs report was released last week to discuss that dynamic and what it means. Greg, I want to start where we usually end these segments, which is what are the most important metrics to watch going forward? And I think we really want to focus on the jobs report, and it has increased in importance as the labor market has softened and is now running really toe-to-toe with inflation is what the Fed is watching, right?
That's right. I mean, for so long, the job numbers were super strong and it just was going on month after month. So that's why it wasn't as important as inflation. But now that it's kind of softening, then people are really watching it carefully because there's always the risk that the little snowball becomes an avalanche. And so people are watching it carefully.
Yeah, well, let's talk about what the jobs report last week really showed us. There were revisions to the previous months. And when we look at the full quarter, it slowed down appreciably, right?
Right. In the first quarter, we averaged 262,000 jobs per month. And in the second quarter, that fell to 177,000 jobs average per month. You know, we had some really strong readings in March, I think, and that kind of skewed the first quarter higher. But you always have to keep in mind that it's coming down from a really strong level. And if you compare where we are now to maybe before the pandemic, the job market looks great.
Yeah, and I'd say overall that seems to be the path for a lot of the numbers we're getting in the economy right now. It's slower than it has been, but it's still not falling to below pre-2019 levels. This is what we talked about at the beginning of the year, Greg, in a soft landing. We're at a point right now where the Fed seems to think that things are in balance, but this is the point where it gets scary and nervousness is increased because when you're in that soft landing, as you said, your worry is the snowball turning into an avalanche.
This is the debate. There's some people who think that things are slowing down now. It's time for the Fed to cut rates a little bit and kind of take out some insurance that this isn't turning out to be a severe downturn. But on the other side of the argument, we have economists who say this is the first kind of sign that the economy is cooling, so we need to keep it in place. I think this is the debate among the central bankers. That mid-September is when the Fed will make a decision. We'll have a lot more data between now and then.
Well, it's interesting that you point to September. We do have a Fed meeting here at the end of July.
Right.
But you don't think they're going to cut at that meeting because they just haven't signaled it yet, and they probably would have if they were looking to cut.
Right. The way they've been going about their business over the last couple of years is to really signal to markets. And so far, the signals that they've sent out from the Chairman Powell to the minutes to other speeches is they need more information on inflation before they're confident enough to cut. From a political landscape, moving in July makes more sense than moving in September. September has always been kind of dicey because it's really close to the election. But July just seems too soon from an economic point of view.
The thing that really gets me, Greg, and what I want to kind of get your temperature on, I really feel that through the end of the year, we're going to see the most crucial time in this post-pandemic economic recovery because we are in this soft landing, because we don't really know where it goes from here with the election coming up and the uncertainty that that already gives. We are in this place right now where it is the most crucial time for the economy. Do you kind of see it the same way?
I definitely agree with you there, but you've had a couple of these episodes before. In the first 2 quarters of 2022, we had 2 straight quarters of negative GDP growth, which is shorthand for a recession. So there were many people who thought there was going to be a recession right around the corner, but the economy was remarkably strong that year. The second half of the year, the economy grew almost 3% annual rate each month. And it kind of kept that up into 2023. And that whole time, I was being asked when the recession was going to start. So we've had a couple of these periods where the economy looked like it was really softening, and it does now. So that's what people are kind of a little bit antsy about.
I mean, just from a consumer perspective, we've seen wage growth decline in recent job reports. While inflation has not been tamed, that is just damaging American spending power. And so we're feeling the pain already as consumers, as the people in the job market, but we're still not to a point where the Fed is going to act to try to alleviate that.
You put your finger on the big conundrum going on now with the economy. The economy has been really good over the last 2 years, coming out of the pandemic, super strong. People have been able to move to jobs, to get better jobs. Workers had power coming out of the pandemic that they didn't have for the past decade. So economists look around and say that people should be celebrating, but people aren't. There's been this whole, vibe that the economy is doing poorly. Economists can't figure it out.
I don't know if it's just vibes, though, Greg. I mean, we are looking at the inflation spike. While wage growth did grow, it was mostly on the bottom rung of salaries. So I feel like there is a wide swath of Americans here that are dealing with decreased spending power because of the inflation spike and the lack of wage growth. And that doesn't look like it's going to change.
I've looked at some charts recently that show workers came out of the pandemic and got raises. Wage growth has kind of kept up with inflation. I don't want to diminish anybody's feelings about the economy. I just think it's really interesting period of time here where we've had pretty good, solid job growth, and I am constantly being asked about a recession. And I think there's tons of reasons for it. I think it's very interesting. Inequality in America persists. And when we look at the data, we always have to kind of parse it so that we're not just sort of blithely talking about how everybody's doing well when they're not.
Now, Greg, I want to turn back to the Fed. I saw the SF Fed President Mary Daly speak a couple weeks ago, and she was the one who really kind of told me we're looking at the labor market as much or even more than inflation right now, because they do see this softening that's happening. And they do have a dual mandate to ensure that prices stabilize, but also they don't want to just slam the job market at the same time. And so they really are looking at the job market really strongly at the Fed right now.
No, you're right. The interesting thing she said was that the labor market, she thought, was at a place where we could start seeing layoffs because companies have kind of gotten rid of all their job openings. They have all the people they want, and the next step is layoffs. And that's what she was worried about. So that is exactly where she is, I think, worried about both those things at the same time and trying to hold them.
Yeah, we're right back where we started with inflation and jobs kind of being what we have to watch through the end of the year as we hit this crucial period ahead of the election and with the September Fed report coming up. Is there anything else you're watching, Greg, that could be useful for those out there kind of wondering where this is headed to make sure they're paying attention for?
I think one interesting thing that is keeping the Fed from cutting rates is the stock market. The stock market has been setting record after record here. And I think for the Fed, it's hard to start to worry about the economy when the market keeps setting record after record. So it's kind of hard to factor in, but it just seems like happy days are here again. So why are you cutting rates?
Right. And I think you're right, Greg. The other thing we're watching really closely and talking about on this episode is corporate earnings. We're experiencing record earnings, while typical Americans, not so much.
Right.
And we'll keep talking to you, Greg, and figure out where the economy is headed over the next few months. Thanks so much for joining us.
My pleasure. Thanks for having me on.
We're going to take a quick break. Coming up, the AI bubble. Stay with us. Welcome back to On Watch by MarketWatch. Before the break, we talked with economics editor Greg Robb. Now, for the first time, we welcome tech columnist Therese Paletti. Therese and I have worked closely together for 9 years, tracking the massive amounts of money flowing into big tech. But this year is different, because not all of those earnings are the kind that Wall Street wants to see. Investors have added trillions of dollars to the valuations of the biggest tech companies in recent years, thanks to excitement about artificial intelligence. But the time has come for AI to show results. A recent Goldman Sachs report pointed out that companies like Microsoft, Amazon, and Google are set to spend more than $1 trillion on AI infrastructure in the near future, with no guarantee that it will produce anywhere near that level of revenue quickly. In fact, a partner at venture capital firm Sequoia recently wrote that tech would have to produce $600 billion in annual AI revenue to justify the cost of this AI build-out. And we are nowhere close to that figure. That setup will put big tech on a razor's edge this earnings season. Investors and analysts will be looking for AI-based revenue to counter the billions that executives are spending on NVIDIA chips and massive data centers. That's the perfect recipe for a bubble, and tech columnist Therese Paletti believes we are in one. Therese, it seems like we're in a point now where the AI hype has kind of passed its peak, and Wall Street wants to see AI results. They want to see the AI money, and the only places really we've seen big AI money so far are NVIDIA and cloud. I think Wall Street wants to see a little bit more, and it's time for some software to show gains. And I think the real test of this may not be NVIDIA, because I think NVIDIA is going to do fine. It's really going to be, to me, Microsoft, and especially Copilot, which is their AI software. It seems that they're offering a little more information on the financial returns for Copilot, because that is proof that businesses want this technology, and that will be the key part to look for in Microsoft's earnings.
Oh, definitely. Yeah, because that's going to be one of the first ones to actually show enterprise buying. Phil Van Dorn, our MarketWatch columnist who writes about investors, he talked to a fund manager who said that he thinks that there's going to be this sort of concern about the whole handoff from people that are building it up, which was also kind of a point of a recent Gartner survey.
Yeah, talk to me about that Gartner survey. It kind of showed that those business customers are struggling to see really where the value is, especially in generative AI.
Gartner is a market research firm, and they recently published a survey where they interviewed a lot of their IT customers, and they concluded that about 49% of the participants in their survey are having difficulty in estimating and demonstrating the value of AI projects. So as they're trying to scale and add AI, they're trying to figure out what is the value and what is the return on investment.
Yeah, that's really the question right now, is the return on investment question. I saw a report from Sequoia that kind of says that with as much as these big techs are investing in NVIDIA gear and AI, that they really need to show about $600 billion in additional revenue to justify the spending. Goldman Sachs had another one where they kind of said something similar.
Right, exactly. And I don't think there's going to be too much evidence yet in this coming quarter.
Yeah, that's really, I think, gonna be a problem in these earnings reports coming up. I mean, the hardware explosion is undoubtedly happening for AI, but mostly because big tech is still so insatiably trying to buy NVIDIA chips and other gear to equip their data centers. But there isn't that much revenue coming into AI software offerings, which Wall Street wants to see. And instead, they're just gonna get more money shoved at them, right? I mean, Facebook has installed a dividend, Google has installed a dividend, and that's shocking to me. You know, previously, these big tech companies, especially in Silicon Valley, have fought instilling a dividend for so long. And the change that signifies is that these companies, so long known for massive sudden growth, now seem to be pivoting to focus more on profit than that revenue growth they've been judged on previously.
Yeah, and that's true with both Meta and Alphabet, because their earnings are growing at much higher rates than their revenue.
Right, and the layoffs were a big part of that. The cuts they did with their employees, and that has been across big tech now, has really juiced their profit margins. But the thing that now sticks out as a sore thumb in this group of big tech companies is Amazon is the only one that does not pay a dividend now. And we saw Andy Jassy, the CEO of Amazon, appears to be a little more Wall Street friendly than his predecessor, Jeff Bezos. He did the stock split everybody was waiting for. Should we be looking for Amazon to instill a dividend? Their profit margins are smaller, especially if you take out AWS, where most of their profit comes from.
Right, exactly. And also, they do have big cash. Their cash jumped in the last quarter. It looked like almost 50% increase. But at the same time, they're also investing in a major way in data centers. And they're trying now to buy actual power because of the electrical grid issues. AI data centers are really power consuming. They use enormous amounts of energy. And Amazon recently spent $650 million on a nuclear powered data center in Pennsylvania. And they are also still looking for more, I believe.
And this is exactly the kind of spending that Wall Street is going to want to see what the return on investment is and what the path is to actually using all of this. And, I think I flash back to the debates me and you had for years about autonomous driving and when it was going to work. And I think that is very instructive to look back on, because I remember 2017, 2018, everybody was saying we're going to have full level 5 autonomous vehicles all on the road by 2020. And it just didn't come to happen. And we've seen that AI actually takes longer than a lot of these futurists want to believe it will take.
That's definitely true, because there is a pretty big AI bubble going on right now.
Is it a bubble? I mean, I think that's what we're really looking for in this round of earnings, is any proof that it's not a bubble.
I think it's a bubble because we don't totally know where all the revenue is going to come from. So therefore, in a way, it's similar to bubbles in the past, like the dot-com bubble, where everyone was building up and nobody was concerned yet about the revenue. There was a big buildup of websites. And also, I recently wrote about the radio bubble in the 1920s, where it took a while for everyone to figure out how they were going to make money from the actual broadcast. So it has some similarities to past bubbles. And especially with, only certain elements of revenue coming in for sure, we don't know where the rest of the money is going to come from.
Right. And the hardware explosion seems will continue because big tech is still so insatiably trying to buy these chips. But they need to, at some point, prove that this AI software has demand in business. And we need to, at some point, show that consumers want AI features and will pay for them.
Well, one thing I've been thinking about is NVIDIA's position in data center, because their data center business has now just become such a monster for them. Like in the last quarter, it was the bulk of their entire business. So when that starts to slow down, it will be a big hit. They still have their automotive business and video gaming, but it's pales in comparison. So it'll be very interesting to see what happens if companies decide that, maybe starting next year, they have enough chips.
And I've said plenty of times that semiconductors are a cyclical business. And in fact, outside of the data center, a lot of these chip companies are going through a down cycle right now, including NVIDIA, especially in gaming. So if they have a down cycle, or at least a slowdown in data center, it's going to be tough to make up, even if they get the up cycle on their other businesses.
Right, exactly. It'll help, but it's not going to be enough to make up for how big the data center has gotten. So it'll be really interesting.
Well, Therese, thank you so much for joining us, and we'll have you back to talk again.
Okay, thank you so much.
Before we go, it's time for What We're Watching, a look at the news you need to know for the rest of the week and beyond. After Greg and I spoke, Fed Chair Jerome Powell testified to Congress and indeed suggested that there will not be an interest rate cut at the board's July meeting. Powell said the Fed needed greater confidence that inflation was coming down and that incoming data for the first quarter did not support such greater confidence. Economists took that statement as suggesting that a cut is still on the table for September, even as Powell said, "I'm not going to be sending any signals about the timing of any further actions." We talked a lot about tech earnings today, but other sectors will take the stage first. Big banks lead off this quarter's parade of earnings reports starting Friday. After regional banks struggled to deal with the rapid change in interest rates, investors flocked to the stocks of the larger banks. JP Morgan Chase, the largest US bank, has seen shares rise more than 20% this year to record highs. Investors are hoping a rebound in investment banking activity justifies gains like those. The other worrisome trend in our economy is a slowdown in consumer spending. While Powell said in his testimony that American spending is still solid, a retail sales report arriving Tuesday will give us more data on that front. I'll especially be watching restaurant spending, which declined the previous month and could tie into a recent drop in leisure and hospitality hiring. And that's it for this episode. Thanks to Greg and Therese. To keep following the latest on the jobs report and corporate earnings, head to MarketWatch.com. You can subscribe to the show wherever you get your podcasts, and please do. If you like what you heard, please leave us a rating or review. It really helps others discover the show. And let us know what you want to hear from us. You can reach us at onwatch@marketwatch.com. The show is hosted by me, Jeremy Owens, and produced by Alexis Moore and Jackson Cantrell. Isaac Gaines mixed this episode. Melissa Haggerty is the executive producer. We'll be back next week with a new episode, and until then, we'll be watching.